Today's SME and SMSF market relies on fit-for-purpose finance and investment solutions that genuinely meet the needs of both borrowers and investors. Think Tank Property Finance is a knowledgeable and established lender larger than most Australian credit unions and building societies. We offer financial solutions for both borrowers and investors. We provide conservative mortgage finance to credit-worthy borrowers, secured by mortgages over everyday Australian residential and commercial properties. Not unlike a bank, this allows Think Tank to pay interest monthly, so investors receive a reliable, no-fuss, zero-fee income stream. Think Tank offers investors a range of investment options to cater for a variety of risk, return, and capital protection preferences. Think Tank has been a trusted brand in Australian financial services since 2006. We have a proven track record of performance in investment and lending in the way we've supported our borrowers and prioritised the interests of our investors through both the good times and the challenging times. We are highly committed to delivering for our investors and maintaining the strong institutional relationships we've built over many years. If you have an interest in regular income investment alternatives, we may have a solution that works for you. Please come and talk to us. We look forward to discussing your needs.
Anyway, we're going to move on now, and a slightly change in pace now. Of course, you would have been living under a rock if you haven't seen all the news about inflation and interest rates rising right now. So this makes this next presentation particularly relevant right now. It's going to be about LRBA lending and operating in debt capital markets. Specifically about pain points about using LRBAs and income generation opportunities from real estate debt. It's going to be presented by Lauren Ryan, who is the Business Development Manager, Investments at Think Tank. So please welcome Lauren to the stage.
Thank you. Is the clicker? Great. Thanks, Darren. And thank you, everyone, for having us today in person and online. For those of you who aren't familiar with us, Think Tank is a non-bank commercial and residential property lender. So we specialise in lending products for self-employed borrowers, SMEs and self-managed super funds in both the commercial and the resi space. Okay, just a quick disclaimer that everything we're talking about today is general. Okay, so quick who we are. We started in 2006. We've been doing self-managed super fund lending since 2013. So we're quite across the complexities of the space. A lot of what we do at Think Tank is with the cash flow of the borrower in focus. So a lot of our lending products are suited to try and provide the best cash flow solution for our borrowers there. We do both commercial SMSF and resi SMSF. I've got some more information outside, so I won't go through these slides in too much detail. And that's the resi one there as well. So we come across some interesting scenarios with our SMSF lending at Think Tank, and we've come up with a few solutions to some of the problems that we've seen. One of them, because we raise a portion of our funding through private investors, we offer a loan that's called a GST loan. And as you'd know, if there's a vacant commercial property, you may be in a situation where the borrower is up to pay for GST, and those funds used for that GST, when they come back from the ATO, they can get captured in the super fund. So we have a loan product available to borrowers called a GST loan, which is very tailored towards the borrowers that we deal with, where we can fund the GST component for that borrower, and then once the refund from the ATO comes back, then they can repay us that loan. So it allows them to use that those funds that would have been contributed to the SMSF, can use that within the business. It also protects those funds from getting trapped in the SMSF once they get repaid back to borrowers. I appreciate that there are scenarios that you can get around paying this GST, but if your clients are in a position where they do need to pay and they're purchasing in their SMSF, this is a loan product that we've been able to tailor specifically for our borrowers. Another scenario we come across is tenants in common. We come across this quite a bit where you have more than one SMSF borrower looking to purchase together. We see this scenario quite a bit and we're able to accommodate, and we understand the complexities of it. So if any of your clients have come across this kind of a lending scenario, we see this quite a bit. And I think there's a few, here we go, let me just, a few little ones up here. Okie dokie. Another one that we've seen a fair bit lately are in specie transactions. We're also, again, able to accommodate here. We understand that there is a potential CGT event if the business sells the property into the super fund, but we can recognise as the lender that the shortfall equity component can be used as or seen as a contribution, and we're able to, again, accommodate these kinds of lending requests. Now, all of our lending origination comes through mortgage brokers. We originate solely through mortgage brokers. So if you've got a mortgage broker that you deal with, or if you don't, we're able to introduce you and accommodate in that sense as well. But we deal a lot with accountants and brokers as well, all on the lending side. And some of the pain points that we're seeing with the SMSF space is borrowers not understanding that you can refinance an SMSF, or if your SMSF LRBA was with the major banks, there are a couple of scenarios. They're either asking you to move on and goodbye, and they don't have a solution for you, or they're asking you to reapply every year. So you're only locked in for 1 year, which is quite a pain point for the borrowers that we're seeing out there. And some of the SMSFs that have been written over the last few years have converted from their interest only to P&I, which is taking a big cash flow hit to the super fund. So we're able to refinance SMSF loans, and we're able to offer that 5-year interest only and a 20 to 25-year P&I, which can really assist with the cash flows. So if your clients are with major banks and they're seeing some of these pain points, feel free to come and have a chat. I'll just be outside and we can talk through some potential solutions there. This is just the refinance I was talking about before. Okie dokie. So on the investment side, this is just a quick graph to show from MSCI over the last sort of 20, 30 years that the income generated from commercial assets has remained relatively stable despite some capital volatility in different markets. This graph is looking at all commercial real estate. Think Tank operates in the small ticket space, so assets under 3 to 4 million. There isn't really a heap of data splitting out your really large commercial assets and your smaller commercial assets, but this shows you a quick snapshot of the consistent income over the last 30 years. So how does Think Tank raise its funds? Being a non-bank, we don't have an ADI. We don't take term deposits and cash and transactions. So we raise our funds through what we call warehouse funding, institutional funding, but it's all from investment. Now, the major banks are big supporters of Think Tank. They've moved away from a lot of this style of lending, as I'm sure you're all aware, because the common tier equity requirements when they write a $600,000, $7,000 commercial property loan can be quite cumbersome. So the way that the banks support us, they provide us with a warehouse facility of, say, $400, $500 million, and we go and write a lot of small loans. Now, they don't give us this funding 100%. Think Tank has to go and source mezzanine funding from credit funds and other income, I guess, companies that need your income. So like your annuities companies or insurance companies. So for any of you who have got clients who are interested in investing in the debt capital markets, there are opportunities within the debt capital stack in around that C and D notes there, where there are quite a few credit funds in the market that you can get access to these kind of income generating assets. They're traditionally only available to institutional style funders. This also provides a loss protection piece for the major banks. So Think Tank has to take an equity tranche in every transaction, and that's the first loss. So income gets paid like a waterfall from the top of the stack all the way down to the bottom. If there are any losses, Think Tank wear those first, and then the losses would get worn from the bottom up. So there's quite a lot of protection for the senior funders, which is why they've been such a big supporter of us for quite a long time. And this is just a quick snapshot of Think Tank's overall loan book. So we have just under 4 billion of funds under management available at the moment. We generate around about $7 million worth of income every month once we've paid all of our investors. So if there are any losses or any arrears during that month, they get absorbed in that income. We use that income to pay our rent, our staff costs, our business costs, and then use any excess to reinvest back into the business. So being quite a large business, we are generating quite a large amount of income. Should there be arrears and losses as interest rates starts to rise and we start to see some economic pressures, then we're in a good position to protect ourselves from those, and protect our investors from those losses. As Darren mentioned, we're starting to see interest rates rise and we are starting to see spreads widen. And that does provide opportunity for investors in those mezzanine credit funds, as I mentioned, because it was funny, our most last recent transaction, because some of the senior funders knew that rates were going to rise in the next few years, they were looking for slightly higher spreads at the time, and this was last year. So we're starting to see some of those spreads increasing now. Even though rates have only just risen, we know that this is the start of a few rate rises. So there are opportunities there. And on the private client side, we have a couple of mortgage trusts, which is how we fund loans that are slightly outside Think Tank's warehouses. Each year we originate a securitization, commercial mortgage-backed securitization and residential mortgage-backed securitization. For loans that don't quite fit in our warehouses, we can fund them privately in the income trust, and then they get securitized out at the end of the year. And in our high yield trust, this is where we fund the GST loans that I mentioned. We also can fund loans that we call a top-up loan if your borrower needs a little bit extra leverage and they're comfortable to pay a little bit more for it for a short period of time. So both of these trusts are available to high net wealth investors looking to generate income from the mortgages. And then we also have available for investment within the credit funds in the warehouses. So we've got a couple of different opportunities if clients are looking for income and they've got a long-term horizon and are comfortable with illiquid assets there. So that is just a quick snapshot as to who we are and what we do. This is just showing the two different trusts and where the equity and the loan sits. I'm going to be here all day. If you've got any questions about the lending side or the investing side, feel free to come and have a chat, and I hope you enjoy the rest of the day.
Thanks very much, Lauren, and thank you very much also to Think Tank's continued support of this event. We certainly do appreciate it because we can't put these events on without that sort of commercial support. So thank you very much to Think Tank as well.